You joined the new company, maybe last week, maybe last month. You went through orientation, signed the paperwork, met the team, and then, sometime in the first week or two, HR sends you an email, benefits enrollment, and here's the catch. You have a deadline, usually 30 days from your start date, to make all your elections. Health insurance, dental, vision, maybe disability and life insurance, and buried at the end of that enrollment, almost as an afterthought, is your 401k, your retirement plan, and you're expected to just know what to do. Your company hands you 7 fund choices, 4 contribution options, and a 32-page disclosure, and says, good luck, this is your retirement. Today we actually explain it. Before we start, one note: if something specific in your plan isn't covered here, we'll address it in a follow-on video. This guide focuses on the decisions everyone has to make. Let's start with what a 401k actually is, because most people get this wrong on day one. It is not an investment. It is a container, an empty bucket with a tax shield around it. The name comes from section 401, paragraph K of the Internal Revenue Code. That's literally all the name means. By itself, the bucket does nothing. A 401k is simply a tax advantage savings vehicle offered through an employer. Money goes in from each paycheck, grows over time, comes out in retirement. That's the whole concept. Now, who's involved? 3 parties in every 401k. Player 1 is your employer. They sponsor the plan. They set the rules, whether there's a match, how big the match is, the vesting schedule, and which investments appear on the menu. Player 2 is the record keeper, the financial institution that holds your money and runs the website. The 3 largest in the United States are Fidelity, Empower, and Vanguard. Player 3 is you, the account owner. The money belongs to you, not your employer, and this matters. If your company goes bankrupt, your savings don't disappear. Federal law under ERISA requires the assets be held in a trust, separate from the employer's accounts. Every dollar stays safe at the record keeper. Quick note on terminology: 401k is the most common plan, but if yours has a different name, 403b, 457b, solo 401k, simple IRA, the core concepts are essentially the same. Only the label on the bucket changes. We'll cover the specifics of each plan type in separate videos. For today, everything we're about to discuss applies. Now, here's the map. 5 decisions. That's it. Today we walk through each one in order. Decision 1, how much to contribute from each paycheck. Decision 2, when do you want to pay the taxes? Traditional, Roth, or a mix of the two. Decision 3, what to actually invest the money in, because the bucket doesn't grow on its own. Decision 4, whether you're capturing the full employer match or leaving free money on the table. Decision 5, what to do with your 401k when you leave the company. Miss any one of these 5 and you're leaving real money behind. So let's take them in order. Decision 1, how much to contribute from each paycheck. When you log into the record keeper's portal, it asks for a percentage. The first thing to know, that percentage is always based on your gross pay, your full salary before any taxes, not your take home. Now, under the Secure 2.0 Act, 401k plans established after December 2022 must auto-enroll you at 3 to 10% with automatic 1% increases each year. Usually the default is 3%. Auto-enrollment is well-intentioned, but 3% is almost never enough. It may not even be enough to capture your full match. So the first move is log in and check the default. Don't let a software setting make the most important financial decision of your career. Now, the part that confuses almost everyone, the paycheck math. People imagine the full contribution disappearing from their paycheck. Here's what actually happens. On a $5,000 monthly gross salary, a 10% contribution means $500 goes into your 401k. That part is true, but in a traditional 401k, that $500 lowers your taxable income. Taxable income drops from $5,000 to $4,500. The tax bill on $4,500 is lower than on $5,000. So the actual hit to your take-home pay is closer to $390. Not $500. The other $110 is money that would have gone to taxes anyway. Instead, it goes into your retirement bucket. The tax code is quietly helping fund your savings. That's why contributing more hurts less than you expect. 2 more mechanics worth knowing before we move on. First, most plans let you contribute either a percentage or a fixed dollar amount per paycheck. A percentage stays proportional as your pay changes. A fixed dollar amount takes the same amount every paycheck, regardless of gross pay. Simple if your pay is steady, but tricky if your paychecks vary because of bonuses, commissions, or overtime. For most people, percentage is the safer default. Second, the IRS annual limit. Your payroll system automatically stops contributions once you hit the cap. No penalty, no paperwork. But switching jobs mid-year is the catch. The new employer's payroll doesn't know what you contributed at your old job. It's on you to track the combined total. If you go over the limit across both employers, report the excess to your new HR before tax filing season. They refund the overage without penalty. Decision 2. Traditional or Roth, the single biggest choice in your 401k. It can mean tens of thousands of dollars over a 30-year career. Think of it like a farmer deciding when to pay taxes on the crop. Would you rather pay tax on the small handful of seeds planted today or on the massive harvest reaped decades later? Traditional is tax the harvest. Contributions go in before taxes. Tax break today. Every dollar withdrawn in retirement is taxed as ordinary income. The reason traditional 401k contributions are popular is that a retiree's earned income typically drops dramatically in retirement. So even though distributions are taxed, they're usually taxed at a lower rate. Roth, on the other hand, is tax the seed. Contributions go in after taxes. No break today, but the money grows tax-free, and retirement withdrawals owe zero taxes. Not on contributions, not on decades of growth, nothing. The standard advice: young and low bracket, Roth; older and high bracket, traditional. That's not wrong, but it oversimplifies. 5 factors actually matter. Factor 1, current versus expected retirement bracket. If your rate is low now and expected higher later, Roth. If it's high now, expected lower later, traditional. Factor 2, cash flow, the factor most advice ignores. A 25-year-old in a low bracket is the textbook Roth candidate. But if rent and student loans are stretching the paycheck, traditional puts more in their pocket today and makes consistent saving easier. Factor 3, time horizon. The longer the money compounds, the more valuable tax-free growth becomes. Factor 4, future tax rates. Nobody knows what they'll look like in 30 years. Roth locks in today's rate. Traditional bets rates stay the same or fall. Factor 5, tax diversification. It doesn't have to be all or nothing. A split creates 2 buckets with different tax treatments, and in retirement you pull from whichever is cheaper that year. Bottom line, there's no universally correct answer. If you can't decide, start with a 50-50 split, and most plans let you change your split anytime. You're not locked in for the year. Decision 3, what to actually invest the money in. The most expensive mistake in 401k investing happens here. The cash trap. Your money is in the 401k. You contributed, but if you never picked an investment, it may be sitting in a default cash settlement or stable value fund, earning a fraction of a percent while inflation eats it. Many plans default new enrollments into these conservative options, and many employees assume the money is invested because it's in the 401k. It is not. It's sitting in a parking lot. The fix takes 90 seconds. Log in, click investment allocation, and pick a fund that actually grows. For most people, the simplest answer is a target date fund. A target date fund, also called a life cycle fund, is the easiest choice. Pick the fund with the year closest to when you plan to retire, usually around age 65. If you're 30 today, that's roughly 2060, so you'd pick something like a target date 2060 fund. Most fund families offer them in 5 or 10 year increments, and that's basically it. The manager does everything else. The allocation shifts gradually from mostly stocks when you're young to mostly bonds as you approach retirement. Here's what that shift looks like by age range. This is called the glide path. The fund rebalances automatically, nothing to do after you pick it. One note, reaching the target year doesn't mean going to 100% cash. It keeps a conservative mix of stocks and bonds, so your money keeps pace with inflation through retirement, which might be another 20 or 30 years. Expense ratios on target date funds have dropped. The average is now about 0.29%. If you want more control or the absolute lowest fees, index funds are the next step up. An index fund tracks a benchmark rather than trying to beat it. No stock pickers, dramatically lower fees, and index funds have matched or outperformed most actively managed funds over long periods. A simple 3-fund index portfolio, a US stock index, an international stock index, and a bond index gives you broad diversification. When you're scanning your plan's fund menu, here's what to check. First, the expense ratio. A fund at 5 basis points, that's 0.05%, costs you 50 cents per year on every $1,000 invested. A fund at 1% costs $10 on the same 1,000. Over 30 years, that gap compounds into thousands. Second, the asset class. Stocks grow more, but swing more. Bonds are steadier, but grow slower. Most people need both. Third, look for the word index in the name, or a benchmark like S&P 500, Russell 2000, Bloomberg Aggregate Bond. That signals passive, low fee. Under 0.10% is excellent for an index fund. Under 0.20 is fine for a target date fund. Anything above 0.50 deserves a hard look. Decision 4. Are you capturing the full employer match? If your employer offers a match and you aren't contributing enough to get it, you're walking away from part of your compensation. The match is calculated as a percentage of gross pay, applied every paycheck. Say your company matches up to 3% of a $50,000 salary. 3% contributes $1,500 a year from the employer. 0% gets you nothing. Contribute more than 3%, the match still stops at 3. Over 10 years, that $1,500 a year with market growth is worth closer to $20,000. So at a bare minimum, your contribution rate needs to be at or above whatever percentage gets you the full match. One catch on the match: every dollar you contributed from your own paycheck is immediately yours. Quit tomorrow, take it all. But the employer's match often has a vesting schedule. 3 common structures: immediate vesting. The match is fully yours on day 1. Less common: 3-year cliff. 0% of the match is yours for the first 3 years. 100% the day you complete 3 years of service. Your 3-year anniversary. Leave before that anniversary, even by a day, and the entire match goes back to the employer. 6-year graded. 20% after completing year 2, 40 after 3, 60 after 4, 80 after 5, 100% after 6. Your vesting schedule is in the plan documents and on the Recordkeeper's website. Check it, and especially before leaving if a cliff is approaching. There's one more trap on the match: front loading. If you max out the IRS annual limit early, say by October, you could miss months of matching for the rest of the year. Most employer matches are applied per paycheck. No contribution that pay period, no match. The safety net is called a true-up provision. If your plan has one, the employer reconciles at year end and pays you the match you would have earned had you spread contributions evenly. Check your summary plan description, that's the document from HR, to confirm whether your plan offers a true-up. If it doesn't, pace your contributions across every paycheck so you don't hit the cap too early. Otherwise, by front-loading or contributing too much early in the year, you may leave real money on the table. Decision 5. What to do when you leave? Because you will, eventually. Your 401k doesn't disappear when you walk out. 4 options. Option 1. Leave it where it is. If the balance is above $5,000, it can stay with the current record keeper. Invested, growing, but no new contributions. Option 2. Roll it into the new employer's 401k. Consolidates everything in one place. Option 3. Roll it into an IRA. More choice, more control. One caveat: if you might ever do a backdoor Roth IRA conversion later, a large traditional IRA balance triggers the pro rata rule, which makes that conversion much more expensive. We'll cover the pro rata rule and backdoor Roth in a separate video. If that's in your future, option 2. Rolling into the new employer plan is often better. Option 4. Cash it out. Almost always the worst choice. Withdrawing before age 59 and a half triggers a 10% early withdrawal penalty on top of ordinary ordinary income taxes on the full amount. On a $50,000 balance, taxes and penalties can consume $15,000 to $20,000 overnight. One related note, some plans allow 401k loans. We'll cover those in a separate video too. Rule of thumb, always roll, never cash out. One critical detail on rolling over, always ask for a direct rollover, trustee to trustee. The check is made payable to the new custodian for your benefit. No tax withholding, no 60-day deadline. The money moves directly from plan to plan. If the check is instead made payable to you, the IRS treats it as a distribution. 20% is withheld for federal taxes right off the top, and you then have 60 days to deposit the full original amount, including the 20% you didn't receive, into the new account. Miss that deadline, and the whole thing becomes taxable, plus a possible 10% early withdrawal penalty. When you call the old plan, use those exact words. Direct rollover, trustee to trustee. It's the single cleanest move in this whole video. 3 changes took effect in 2026 under the Secure 2.0 Act. First, mandatory Roth catch-up for high earners. If you're 50 or older and earned more than $150,000 in payroll wages from your employer last year, your catch-up contributions must go Roth. Second, enhanced catch-up for ages 60 to 63. Workers in that 4-year window can now contribute up to $35,750 a year. Third, mandatory auto-enrollment for newer plans. Plans established after December 2022 must auto-enroll at 3 to 10% with annual 1% increases. Here are the 2026 IRS limits in full. Standard employee deferral under age 50, $24,500. With catch-up 50 to 59 and 64 and up, $32,500. Enhanced catch-up 60 to 63, $35,750, and the total across all sources, including employer and after tax, $72,000. That $72,000 number matters for high earners whose plans allow after-tax contributions. Those can sometimes be converted Roth through the mega backdoor Roth, a strategy we'll cover in a dedicated separate video. So let's bring it all together. 5 decisions. Here they are with what to actually do. Decision 1, contribution rate. At a minimum, set it high enough to capture the full match. If default is 3 and the cap is 6, move it to 6 today. Decision 2, traditional Roth or split. If you can't decide, go 50-50. You can change it any time. Decision 3, investment allocation. Move your money out of any default cash or stable value fund into a target date fund or 3-fund index portfolio. The step almost everyone misses. Decision 4, the match. Confirm you're capturing it in full, check your vesting schedule, and make sure your plan has a true up if you plan to front load. Decision 5, when you leave, always roll. Direct rollover, trustee to trustee, never cash out. If backdoor Roth might be in your future, prefer rolling into the new employer's plan over an IRA. That's the whole decision map, and here's your action plan. 4 steps, 1 afternoon. Step 1, pick your tax bucket, traditional Roth or a split. Don't freeze, just choose. Step 2, set your contribution rate to at least the full match cap. Step 3, move your money out of any cash fund and into a target date fund or a low-cost index portfolio. Step 4, every time you get a raise, bump your contribution up by 1%. You won't feel it because your take-home just went up, but over 30 years, those 1% bumps compound into a much larger retirement. 1 afternoon, 1 login, decades of compounding working in your favor. The hard part isn't the decisions, we just walked through them. The hard part is starting. Don't wait. Follow Retirement Compass for the next one. Next Sunday, we dive into the IRA, the retirement account every 401k saver should understand, including the mega backdoor Roth we mentioned earlier.